In profitability analysis, we want to explore the sources of profitability. So we are already familiar with the profitability decomposition because we made the DuPont analysis in previous classes. You can recall that there were DuPont 3-factor, DuPont 5-factor analysis. But apart from that decomposition, I mean exploring the sources of profitability through the DuPont analysis, 3-factor or 5-factor, it is also possible that we can make a more detailed analysis of profitability with the help of reformulated financial statements. So for understanding this content, it is essential that you have understood the reformulated financial statement analysis issues and the ratios we calculated using the reformulated financial statement. Okay, so we have made the term the decomposition of profitability, but here we will make this kind of analysis, the profitability decomposition, using the reformulated financial statement, reformulated financial statements. So this kind of process where we are analyzing the profitability with the materials from the reformulated financial statement analysis is known as the spread analysis. So here you see that we have a balance sheet and we have a income statement. So we will make the decomposition, or we'll find the sources of profitability in 3 levels. So there is a level 1 decomposition, there is a level 2 decomposition, there is a level 3 decomposition. Decomposition is simply looking for the sources of profitability. So it's nothing special. We already are familiar with such kind of exercise. Okay. So you can recall that in DuPont analysis, when we did the DuPont analysis, we are given 3 sources of profitability. You can recall that there was a profit margin, and there was the asset turnover, there was the equity multiplier. So what do these measures actually reflect? You can recall the profit margin reflects the profitability, the asset turnover reflects the efficiency, the equity multiplier reflects the leverage. So if we do not make a decomposition, say we have simply net income over the average shareholders equity, which is ROE. So we have a profitable profit indicator, but we cannot measure or we cannot identify what are the sources of profitability. So if we have only the ROE percentage, say 10% or 15%, what can we tell about it? We can tell that for each dollar invested as equity, we have generated 10 taka. We have generated for $1 invested in as equity, we have generated 10 cents or 15 cents from equity investment. But when we are making a decomposition in using the reformulated financial statements, it is a more broader concept. And compared to DuPont analysis, this kind of spread analysis is more comprehensive, more detailed, and more holistic. So this balance sheet, this income statement are of the company, the BD Lamps, which is known as Bangladesh Lamps Company. So I believe you are familiar with this company. This company produces lamp. This company produces lighting materials, and this company also engaged in installing the floodlight in Mirpur Stadium or other stadiums in our country. So this Bangladesh Lamps Company, their main business is to produce and sell the lamp, okay, or bulb this kind of materials. Okay. So about this company, as I have given you the idea, this company is located in Mohakali. They have their operation. I mean, their factory, their manufacturing plant is there. But the thing is that this company, as you have understood the nature of the company, you can identify what kind of assets of this company should be operating asset, and what kind of assets of this company should be financial asset. So you see that I have identified the operating assets and the financial assets in the green color, using green color. But you see the presentation of the balance sheet is somewhat different from the presentation in the annual report, where the financial statements are given. This is a file which is from the Lanka Bangla financial portal. You probably have used the Lanka Bangla financial portal on the front screen, and you collect the financial statements data available from the portal. So these are the files which are on the back side of the Lanka Bangla financial portal. So they actually uploaded this file, and the numbers, the items are presented in the website. So when I was an intern in 2013, as a BBA student, I worked in Lanka Bangla Securities, and I worked on preparing this kind of files. And one of our responsibilities was to feed the data in this kind of Excel files and to upload this into the Lanka Bangla financial portal. So this portal was developed during that time. So you see that they have created a general format. So some items are 0, because these items may be available for some other companies, and these items are not available for the Bangladesh Lamps company. That's why these items are 0. Okay. And you see these items are given. So these items are applicable for the Bangladesh Lamps company. So let's see some operating assets and some financial assets and operating liabilities and financial liabilities of Bangladesh Lamps Limited. Okay. So you see that for Bangladesh Lamps company, the property, plant and equipment, then the intangible assets. These intangible assets includes the software they have purchased for managing their operation, and inventories in the out of the current asset, then the trade and other receivables, cash and cash equivalent. So these items are operating asset. There is no confusion, and we know why these are operating asset. But you see that we have identified the other investment as a financial asset, because in the financial statements note they have reported that they have a bank deposit in FDR account, which has been included in the other investment. So that's why it has been identified as a financial assets. So with respect to cash and cash equivalent, we know that there is a portion of operating cash and there's a portion of cash equivalent, which is look like a financial investment or financial assets. But this company has not provided details about the cash and cash equivalent. That's why it has been considered as total the operating asset. And this company has some capital items. You see the stated capital and the reserve. So this will be part of the common shareholders equity. You can recall the CSE, not the computer science and engineering. It is the common shareholders equity. Okay. And these are about the assets and the common shareholders equity. But with respect to liabilities, we see that there is a interest-bearing borrowings. It's a long-term debt, interest-bearing borrowings. In 2009, there are 2 years. In 2009, there was no interest-bearing borrowings, but in 2010, they have this amount of interest-bearing borrowings, which is that loan taken from the Eastern Bank. And you see, these items are financial liabilities. However, the deferred tax liability, as we mentioned before, that this should be the operating liabilities. And another item might be new to you, but not uncommon among the companies, which is the retirement benefit obligations. So it is for their working employees, and this liability has been considered as operating liabilities, and you can justify the reason the employees are working for the operations. And if you incur the liabilities for giving them the retirement benefits, that should be part of your operation, and that should be considered as operating liabilities. Okay. But you see that there are some other out of the current liabilities. Here you see that these are part of current liabilities. There is a short-term loan, which is from the Southeast Bank and EBL in terms of overdraft. Then there's a current portion of interest-bearing borrowings. Current portion of interest-bearing borrowings. So these are part of the financial liabilities or financial obligations, more precisely in terms of reformulated financial statements. Because these come with the interest obligations. If we have these items, we need to pay the interest. Okay. So you know what does it mean? The current portion of interest-bearing borrowings. It is an amount which actually comes from this, the Eastern Bank loan, the interest-bearing borrowing. So it is the interest-bearing borrowing, the portion of the borrowing, which includes the principal, which includes the interest liabilities also. But this portion is due in this particular year. So that's why it has been separated from the total amount, and it has been reported as the current portion. But actually, this is a portion of the long-term loan taken by this Bangladesh Lamps company from the Eastern Bank. Okay, so these are the ways that how can we distinguish the operating and financial items about the on the balance sheet. Okay, so current portion of long-term debt. That is a question. Current portion of long-term debt is installment of a loan. Yeah, the installment which has been due in this year. So that is the current portion of interest-bearing borrowings. Okay. Now let's look at the income statement, and we have learned that how can we reformulate the income statements, and we also have learned there are some principles of reformulating the income statements you can recall. So what we do, we generally classify the income statements items into two broad classification. One is operating, and another one is financial. In addition to this, we also make an allocation of taxes. However, the operating section is further allocated into two subgroups. You can recall the operating income from sales and other operating income. Okay, so here you see the revenue. We have termed this as a core activity, so it's a part of operating income from sales. Similarly, the cost of sales, you see this is part of the operating income from sales, that section. Same for administrative expenses, same for depreciation, amortization. And these are part of my operating income from sales. So we see that after the operating profit estimation, after the estimation of operating profit here, they have included the employee benefit expenses. But if I ask you that it should be part of their operating or it should be part of their financial, employee benefits expenses, You see, this is the employees are working for the operations. So if you spend money for providing okay. Again, I was asking the employee benefit expenses. Employee benefit expenses. So it has been shown after the estimation of the operating profit. But what I'm asking that do you think it should be subtracted before calculating the operating profit, or it should come after calculation of operating profit? Give your response in the chat box. What do you expect? As it is a part of the operation, it should come before estimation of operating profit. So this should be corrected when we will make the reformulation of income statement. And we see that there is a finance expenses. Can you recall the financial obligations of this company? Can you recall that we mentioned that this company incurred the interest-bearing borrowings long term? Then there was a current portion of interest-bearing debt. Then there was another financial obligations. Can you recall? One is interest-bearing borrowings. Yeah. Another one is short-term loan. Okay. Short-term loan. So for these financial obligations, this company incurs financial expenses. This company incurs financial expenses. Similarly, we see this company also generates financing income from some financing activity. So how it is possible that this company which should produce or which produces lamps, which produces bulbs, this company generates income from financial investment. So from the financial statements note, they reported that they have made investment of surplus cash in equity securities. So they generate income through dividend. In addition to that, can you recall that they made a investment in FDR account? Can you recall that I mentioned earlier, investment in other assets, the balance sheet? They made investment by keeping their deposit in the FDR account. So you know that when you maintain FDR account, you get interest income. So that should be part of the finance income or operating income. The interest income you are generating from the investment of surplus cash in the FDR account. That should be part of the finance income. Nice. Then in the red color, you see there is the item which is the other revenues and profits. So this is a non-core activity. This is a non-core activity. And we have given a note here that rent income. This is not operating income from sales. This is not financial income or the financial income expense part. This is part of operating income, other operating income, or operating income other than sales. Now let's try to identify what is the reason that why they are generating this kind of income. So what they actually have done, they have mentioned that they have let out a portion of their factory in Mohali as a sublet. So they generate income from there. So you see that that's why this kind of rental income has been included as a other operating income. It's not part of the financial income or not part of the operating income from sales. So to precisely identify whether it should be operating income or it should be part of the other operating income or it should be part of the finance income, it should be part of the finance income. You see that what they have done, some people are responding that it should be finance income. They have not made a separate investment. They have not made a separate investment. They have let out a portion of their operating plan. They have a manufacturing plan. A portion of their plan has been let out. So they are not generating the, it is not that they have invested their surplus cash. So it has been considered as other operating income. So to precisely identify whether it, what kind of income it should be or what kind of expense it should be, we need to precisely know the nature of the business of the company. Okay. So other than this, can you recall that this income tax expenses we allocate in the reformulated financial statements, we allocate this income tax expenses into 3 sections. We identified earlier. We know that this income tax expense includes the tax liability, tax burden for the operating profit coming from sales, other operating profit from other operating activities. It also needs to be allocated for the tax benefit or the tax burden, whatever it is, with respect to our net financial expenses or net financial income. So we know this. So to make the spread analysis or the decomposition of profit, we need to first identify this balance sheet and the income statement items separately. And then we need to prepare the reformulated financial statements. So this exercise has already been done. So how can we reformulate the financial statements? So I will be a little bit hurried to show you that how can we calculate this, and try to follow and try to correct me if I'm wrong. Okay. So these numbers are given, but I will show you that how these numbers can be calculated. Okay. So first let's calculate, we need to calculate these items before going to the spread analysis. So the first item, the operating asset or total operating asset. How can we compute it in the balance sheet? Let me write it here. In the balance sheet, let's try to identify what are the operating assets. Okay. So here you see that property, plant, and equipment I have identified is as operating asset. Intangible assets, I made a statement that it's for software, IT software. And the other non-current assets, I have made it operating assets, and other investment should be part of the financial assets. I mentioned the reason earlier, the inventory should be part of the operating asset. Then the trade and other receivables, obviously it should be part of the operating assets. Then the cash and cash equivalent, I already mentioned the reason why the total amount has been included as operating asset. Then the other assets, there is no elaboration. What it has been included here has been considered as operating asset. Advances, deposits, and prepayments probably. So that's why it is included as a operating assets. So if we add all of the operating asset, we see that this is the operating asset, the same number. So we know that how can we compute it? Similarly, for operating liabilities and the financial assets and financial obligations, we know that how this can be computed. We should have no confusion. We already have done several exercises how to compute this, and you all also have solved the problem. Okay. So can you recall what was the CSE And we know that how can we get the net operating assets. So then the net operating asset is the difference between the total operating assets and the total operating liabilities. This is the net operating asset, the same number. Okay, so it will be good if I okay, there is some decimal number for percentages, but it would be good if we separate the currency numbers into using the comma. That will be easy to identify about the amount. Good. Okay. So you can recall that common shareholders' equity can be computed. How? We know that which items are included in the common shareholders' equity, and it can also be computed by subtracting the net financial obligations from the net operating assets. Farmida, thank you. So we can also get this number, the common shareholders' equity, by summing up here. You can see the this one, stated capital and the reserve. These are common shareholders' equity items. Okay. So in the balance sheet, they have included the minority interest, but again, note that this is not directly the balance sheet reported by the company in their annual report. This is the structure made by the Lanka Bangla Securities for their internal data feeding purpose in the financial portal. So we know that minority interest is a separate part out of the total equity. So minority interest should not be part of the total equity. So minority interest is a completely separate part. The interest in a particular company of which we have not acquired the position. So it can be 1%, it can be less than 1%, whatever it is a very insignificant. We do not include it. Okay. So we measure the leverage. Can you recall that how we measure the leverage in the traditional financial statement analysis, other than reformulated financial statements? Can you recall that if I ask you that how you measure the leverage, what will be your answer? What do you do generally? You divide the total liabilities by shareholders' equity. You divide the total liabilities by shareholders' equity. Alternatively, sometimes people take only the long-term liabilities. But if you are very conservative, you might include the preferred stock, considering it looks more like a liability. And you might include the lease obligations. You might include the short and long-term liabilities when you are more conservative to measure the leverage. Okay. So, but in general, if you follow the practice, you either take the total liabilities and divide this number by shareholders' equity, and you measure the leverage, or you take the long-term liabilities and you divide this number by shareholders' equity, and you get the leverage. Okay. But we have learned that in your exam, there was a question that you compute the financial leverage, F-lab. Some people asked me, what does the F-lab indicate? So the answer was, it indicates the financial leverage. So in class, we have learned that how can we compute it? We compute it by taking the net financial obligations and dividing this number by common shareholders' equity. So let me show you how can we compute it. Okay. So say we have net financial obligations. So this number, net financial obligations. So we know how to compute the net financial obligations. And we need to divide this number by, we need to divide the net financial obligations by common shareholders' equity. So what does it mean? The 0.74, it indicates that for each taka of common shareholders' equity, this company is incurring net financial obligations of how much? 0.74 taka. Okay. Now, so we have learned how to calculate the financial leverage. It is our from previous learning, nothing new here. We already know. Okay. Net financial expenses. Net financial expenses. How can we compute it? That is the question. Okay. How can we compute the net financial expenses? Okay. Can anyone recall that? How can we compute the net financial expenses? So let me show you. In the income statement, we already have identified what are the financing expenses. Here it is. And if we subtract which one? The finance income, this number should be the net finance expenses. So this net finance expense, should be positive for what kind of company? Net finance expense should be positive for what kind of company? The company which has more net financial obligations, or the company which has more financial assets? The company which has more financial obligations, absolutely. And otherwise, it would have negative net financial expenses, or it would have positive net financial or net finance income. Now, the average tax rate. So can you recall that we measure the effective tax rate by how? We measure the effective tax rate by dividing the income tax expenses here, by dividing the income tax expenses by the profit before tax. So you see, this is the effective tax rate. Here we have identified is a average tax rate. So we see the Bangladesh Lamps Company on an average incurs effective tax rate of 22 to 25, or on an average 23%. Okay, so you can recall that in reformulation, which tax rate should be used? Effective tax rate or the marginal tax rate? The question to you. You can recall the marginal tax rate. Okay. So right now we do not have the marginal tax rate. So what we are doing, we are proxying the marginal tax rate with average tax rate, as we do not have the marginal tax rate number. Okay. But note that always in the reformulated financial statements, we need to use the marginal tax rate, not the average tax rate or the effective tax rate. Okay, let me repeat how we have computed the average tax rate. This is the income tax expenses in the income statement. Income tax expense here it is, say this one for 2009, and divide this number by the taxable profit. Okay, this one. So this is the way how can we compute the average tax rate. Okay, so next one, when we have the borrowings, we already have learned that this company has a net financial expense positive number. That means this company has a more borrowing than the investment of surplus cash. Okay, so this company incurs this amount of net borrowing cost. This company incurs this amount of net borrowing cost. So how can we measure it? The first question to you, we already have learned that this company has incurred how much finance expenses? This one. So it reflects the borrowing cost. Does it reflect the actual borrowing cost? The question to you. No, because we get some tax advantages. So what is the net borrowing cost? In fact, if we subtract the tax amount or tax benefit in this way, you know how to calculate the after-tax interest expense. If you completed your CID, Capital Investment Decision course, you are, sorry, not this one. Okay. We have the net financial expenses. Where this one, we have a net financial expenses. So when we have a net financial expenses, we get tax benefit or we incur tax burden? The question. When we have a net financial expenses, we get tax benefit. Okay. Okay. So we need to divide. We need to subtract that benefit. How? If we subtract the tax percentage in this way from the net financial expenses, this one, we can estimate how much is my after-tax net financial expenses. Here we have identified this term as a net borrowing cost. Okay, so in this way, what we are doing, we are calculating the net borrowing cost, and we also have shown it when we discussed about the ratios using the net borrowing cost. Okay, so we need to make some adjustment to operating income. Can you recall for what reason we should adjust the operating income? The operating income which has been reported here, this one. There is an operating income they have reported, but we need to look at the definition of the operating profit given by the company, because you see that they have not included this, which is a operating part, and we have to find out necessary adjustment. Okay, so what can we do? Can you recall that I mentioned that employee benefit expenses is a part of operating expenses, and I also mentioned the income coming from renting out the factory premise should be part of the operating income. So what can we do? We can make some adjustment with the reported operating profit in this way. Follow my calculation. What I'm doing, I'm taking the reported operating profit, I'm subtracting this one, employee benefit expenses, because this has not been subtracted, that's why I have subtracted. Okay, now I'm adding back the operating income coming from renting out of the factory premise. So what is the adjusted operating profit? This one. Okay, so we have this adjusted operating profit. So you have learned that why we need this kind of adjustment when we see that some operating items have been excluded from calculation of operating profit. So can you recall that this operating profit was calculated in which row? Number 21 row, right? But when we calculated tax in the row 39, so what does it mean? This after this adjusted operating income, what we just have estimated, is a after tax amount or before tax amount. So to make it after tax, what we need to do, we need to subtract the average tax rate from this adjusted operating income. So how? 1 minus this one. Where is my average tax rate? This one, in this way. So here is our after tax adjusted operating profit. Someone has asked to repeat the estimation of net borrowing cost. So we have estimated the net borrowing cost. You see that we have a net financial expenses. We have a net financial expenses. So what I was stressing that this net financial expenses is a before tax net financial expenses. But we know that when we have a net financial expenses, we get some tax benefits or tax advantages. So to subtract or to consider, to recognize that tax advantages, we need to get the after-tax net financial expenses. So that's why we have taken this net financial expenses and subtract the tax benefit in this way, the average tax rate, and here it is. Okay, so it is the net borrowing cost. I mean, after consideration of taxes. Okay, next one. Okay, let's see, is there any question? Okay, fine. Okay, so let me ask you a question. If I generate income by investing equity in other companies, it should be part of the operating income or the financial income? Long-term investment in equity of other companies. It should be part of the operating income. Yeah, good. Someone has again asked, if the marginal tax rate is given, then we'll use the for after tax net borrowing cost. Yeah, I already have mentioned it. So you might ask that why in calculation of after tax or adjusted operating income, why we are adding back the rent income? So the question is that here, the answer is that we are not utilizing the surplus cash, but if we would utilize surplus cash, if we would utilize the surplus cash, in that case, we would consider it as a financial income. Okay, so we can add another class in the income statement. You would see apart from the operating income from sales, other operating income, and the financial income, there is another classification. You might see the unusual income or the non-recurring income or non-recurring items, which might include the revenue gain from the sale of my operating assets. So generally, this kind of classifications are used, but we are not using that classification. But I just have mentioned the unusual income or the non-recurring income. Okay, so we are allocating tax in the after this operating income. How? This is the adjusted operating income we already have estimated, and I already have shown to you. So I mentioned that we can calculate the after-tax adjusted operating income by subtracting the taxes from this operating, from this adjusted operating income. Okay. So the next issue I like to ask from you, we make a credit sale. When we make a credit sale, we generate the accounts receivable. Okay, and when we make a credit purchase, we incur the accounts payable, right? So do you think when we have the accounts payable or when we make a credit purchase, do we involve any cost for purchasing goods on credit? There is a implicit interest rate. Okay. So how it is possible? So say, for example, Bangladesh Lamps Company, purchases cables from the BVS cable on credit. So one invoice has been reported that this will be 1 crore taka. But Bangladesh Lamp is saying that I do not have the cash. I will make payment in 3 months installment or 5 months later. So BVS cable from which the Bangladesh Lamp is purchasing the cable, BVS cable will tell the Bangladesh Lamps that you can purchase this, but if you make the cash payment, this invoice value will be 1 crore taka. But if you make a credit purchase, in that case, your invoice will be amounting 1.1 crore taka. You see that for credit purchase, my costing has increased. Say this costing increase of 0.1 crore or 10 lakhs is for 6 months. So it's about 10% in 6 months period. But if we annualize this 10%, what would be this 10% annualized? This 10% cost, you already have understood that how we measure the 10%. Yeah, this should be 20%. So you see that when we borrow long-term loan, we might incur 11%, 12%. But when we are making this kind of borrowing through accounts payable, we are incurring around 20% interest rate. So you think that this is a huge amount, and it is not an explicit amount, it is an implicit amount, and it cannot be observed directly from the income statement, but it has impact. Because when I am purchasing 1 crore taka goods at 1.1 crore taka, it has increased the cost of purchasing inventory. So it will also have impact on my income statement and profit in general. So we'll talk more about it later, but we have recognized that for incurring operating liabilities, like the credit purchase with accounts payable, or it can be utilities payable, it can be wages payable, it can be others payable, we have to incur some implicit interest cost. Okay, but no company will tell you that what is the cost of this kind of implicit interest rate, or what kind of cost they incur for purchasing goods on credit. Okay, so what can we do? We can assume, or we can proxy this cost, the cost for operating liabilities or cost for current liabilities, by looking at the trending inflation rate. You know that inflation is measured by consumer price index. So we can take the inflation rate as a proxy to reflect the implicit interest rate. So you might ask, why the inflation rate? Why not other rate? The answer to that question is that when someone is selling goods on credit to you, he will likely to make sure that he is incurring, or he is charging at least the loss of his purchasing power of money throughout this credit period. So that's why we have taken the consumer price index as a proxy for short-term borrowing. Similarly, we know that this short-term borrowing should be considered, this short-term borrowing rate should be considered as after tax. So you understand that from where this short-term borrowing rate has come. So again, we need to consider that this should be after tax interest cost. This should not be before tax interest cost. Okay. So how can we measure it after tax? If we take the before tax rate and we subtract the tax rate in this way, our average tax rate, where it is, yeah, this one. So we have this after tax interest, bearing, or after tax short term borrowing rate. Okay. So someone has asked why we don't take the treasury bill rate. Okay. So what I mentioned, that this is the minimum. This is the minimum. And if the situation is like that, you better proxy the short-term borrowing cost by the treasury bill. And in that case, you can also use it as a proxy. As I already have mentioned the argument that why we are using it. And you can also think of other available proxy. You have mentioned one proxy that is a very good. Okay. Now, you can recall that we already have measured the operating liabilities here. We know how to measure it. Okay. Here we have measured the operating liabilities. So if we have the operating liabilities here, we have the after-tax short-term borrowing rate here. Is it possible that we can measure the dollar amount of implicit interest cost? How? Equals to these operating liabilities which we are incurring multiplied by this after-tax short-term borrowing rate. And we see this is our implicit interest cost on operating liabilities. Okay. So we have produced our materials which will be required for spread analysis later. Okay, we have our raw materials now ready. Okay, now next let's return. Let's go to the main part. We already have our materials ready. Note that this should be prepared before making the spread analysis. This should be prepared. Okay. If you do not have these materials, you might not complete the profitability decomposition in a good way. You have to go for calculation again and again. Okay. So we have our materials ready. First of all, level 1 breakdown. In the first level, we like to decompose the profitability. Do not forget the purpose, why we are here, what we are trying to do. So we start with calculating ROE. So can you recall that how we measure the conventional ROE? We measure the conventional ROE in this way. We divide the profit after tax or net income by common shareholders' equity. Okay. So let me show you how can you calculate it. I have not asked for how we decompose it. You have mentioned the DuPont decomposition, but I'm just wanting to remind you that how we measure the conventional ROE, but we decompose it in a different way today in the spread analysis. So let's calculate it. Okay. So we have this profit for the period, and we divide this number by, we have measured the common shareholders equity for 2009 here. Yeah. So it is how much percentage? It is the this percentage. We know how to calculate this ROE. Okay, fine. So what does it indicate actually? Out of 100 taka investment as a equity, this company has generated 20 taka plus for equity holders in 2009, and in 2010 it has generated 19.13 taka. Okay, so up to this, there is no difference between the DuPont analysis and the spread analysis. But when we explore the sources, then the differences start. Okay, so now let's start the decomposition. Here, what we are doing, we will decomposition means allocation. We like to find out what are the sources of this 20.297%, similarly for 19.132%. Okay, so here we like to see what is the impact of leverage on this profit. Note that in the level 1 breakdown, I have mentioned here in the sheet name, in the level 1 breakdown, our purpose is to measure the impact of the leverage. Okay, do not forget the purpose. You will confirm the purpose after having the calculation or after having the understanding of the total scenario. Okay, so for this purpose, to determine the impact of leverage on our profit or on our value generation, I am using the profit and the value generation synonymous way. I am reflecting that this is the value generation or this is the profitability. Okay, we like to find out what are the sources of this. Okay, first of all, we need to determine the return on net operating asset. We need to determine the return on net operating asset. From the name, you can immediately recognize what we want to see. Okay, so how can we get the return on net operating asset? We get the return on net operating asset if we take the after-tax adjusted operating income. You see here, after-tax adjusted, after-tax adjusted, after-tax operating income. Here you see we already have calculated it, and if we divide this number by the net operating asset, where it is, we have this number here. Okay, so how much is this percentage? 13.71 or 72%. Okay, so what does it indicate? It indicates that out of the 20 taka, 20.297 taka, which has been the value added in the 2009, 13.72 taka is coming from investment in net operating assets. Okay, now the question is, you know the operation of the Bangladesh lamps. So you know that for what purpose this net operating asset has been purchased and for what purpose this company has invested in the net operating asset. So investment in the net operating asset is giving how much? 13.72 taka, out of which amount? 20.30. Okay. Now the question is the remaining amount, about how much? About 7 or about 6 point something. Okay. So this amount is coming from where? That is the question. This amount is coming from where? So what is that number? So that number is actually, you see that if we make a subtraction, this is the return on equity or return on capital employed, whatever it is. You see the 20.297% as this number. And we already have seen the net impact of return on net operating asset is 13.717%. So there is a gap of how much? The green color, 6.5181%. So we are claiming this. We are claiming that this percentage, the 6.581%, is coming from some impact of leverage, some impact of financial leverage. Okay. So let's try to verify it. Why we are claiming it? Okay. Can you recall that we measured the financial leverage? We measured the financial leverage. Okay. Can you recall that we measured it in the previous sheet? How can we measure the financial leverage? Okay. So here is our financial leverage percentage. Okay. This is the 0.74 something. We already have indicated what is the interpretation of this 0.74. Okay. Now, to measure the impact of the leverage, we need to estimate the net borrowing cost. Can you recall that we measured the net borrowing cost? We measured the net borrowing cost, but in dollar term. We measured the net borrowing cost in dollar term. Can anyone tell me what was the net borrowing cost? The definition of net borrowing cost? Can you please remind us? Net borrowing cost, how can we measure it? Is it the net financial expenses over, is it the net financial expenses? Okay. Okay, let's check. Tax adjusted net financial expenses, fine. So let's try to find out net financial expenses. Okay. You see that we measured this net borrowing cost, the one which I have selected. This is the after tax amount or before tax amount. So you have mentioned it precisely that it is the after tax, the net financial expenses. Okay, this one. Okay, this one. So what we are doing here, we are taking the after tax net financial expenses here, this one, or the net borrowing cost, which is a dollar term here, and we divide this number. Can you tell me why we have incurred this? Because we have the net financial obligations, right? So if we divide this, the after tax net financial expenses, or here NBC, by the net financial obligations, we see that this is the net borrowing cost in terms of percentage. In terms of percentage. Okay. Now we see the net borrowing cost in terms of percentage. Okay. Can you tell me how much the company is generating by investing in the operation out of 100 taka? Out of 100 taka investment in operation, how much this company is generating? $13.71 taka. Okay, fine. Now the question, follow-up question. For 100 taka financial net financial obligations, how much cost I am incurring after tax? For 100 taka net financial obligations, how much cost I am incurring? 4.842 taka. Okay. Now, if I generate more return by investing in operation and I incur less cost through financial obligations, should I borrow more or increase my financial obligations and take more loan or make more borrowing and then invest in my operations? So logically, yes. If I have more return on investment simply rather than my cost of borrowing, in that case, I should go for making borrowing and I will go for making investment. Okay. And the opposite is true. Now, can I measure what is the spread here? You see that I have return from investment in net operating asset 13.7 some 13 point some percentage of starts with 7, and I incurred this borrowing cost. Okay, I measured this difference, and this difference is about how much? 8.875%, and this is known as the spread here. So this spread is known as the financial leverage spread. This spread is more precisely known as the financial leverage spread. So you know that what we have done here, we have subtracted the net borrowing cost from the return on net operating asset. Okay. Now, so we have some raw materials covered or raw materials calculated for estimating the impact of leverage on the profit. Do not forget the purpose of level 1 breakdown of profitability. Okay. So let's try to find out what is the impact of leverage. Okay. Equals to this spread. This spread. Okay. We know what does this spread indicates. Okay. I have taken the spread, multiplied this percentage, the spread, by my FLAP or financial leverage to measure the impact of leverage, or precisely to measure the impact of capital structure. Okay. You see that this percentage is 6.581%, which was the remaining out of the 20.297% after subtracting the accounts for the impact of operation on profit or impact of return coming from investment in net operating asset. Okay. So have you seen that this true breakdown? So 13.71 indicates what? Indicates the return which is coming from return on net operating asset. But we understand the remaining 6.581% is coming for what? Coming for the notion that we have taken financial obligations. One part is this one, that we have more financial obligations. That means we have a leverage. And second part is that we have a positive spread. So we see that by combining these two, the financial leverage, you see the blue line, the blue colored one. Okay, we have actually done this one. The financial leverage is some 0.7414, and the financial leverage spread is 8.875%. So if we multiply this, we get what? We get the impact of capital structure on profit. Okay. So this 6.58% value is coming from where? Coming from use of leverage. So if the firm is under levered, in that case, this company can increase the borrowing for taking the tax advantages associated with borrowings. So here you see the value addition for leverage is coming in which way? Is coming in a tax advantage because borrowing gives us the tax advantage. Okay. Now, actually, how this value is coming? If we do not make borrowing, we would not get tax advantages. So when we make tax bill or when we make payment of tax bill, we pay to whom? We pay to the government, right? We pay to the government. So if we save $1 or if we save 1 taka by not giving tax to the government, who will claim this profit? A question to you. If I save $1 of tax expense by not giving it to the tax authority, who will claim this profit? Shareholders. So it will give more return on equity or return on capital employed. So the issue is that the use of leverage generates value. And here in case of Bangladesh Lamps Company, it is 6.581%. And the impact of the operations, and operations should be a bigger number. They have set up their business to make the business of lamp. They have not been set up for other purposes. Okay, so it should give more. So you see that the spread, again, the spread we have calculated is 8.875%. So do you think if we can reduce our net borrowing cost, we can generate more spread? If we can reduce the net borrowing cost, is it possible to get more spread? What do you think? It is possible to get more spread. Okay. Have you learned that our business conglomerates like the Pran RFL or like the Summit Group have taken loan from the foreign countries or foreign financial institutions like IFC? Have you learned about this, that our companies want to get loan from these foreigners? So foreign loans comes at a lower borrowing cost. So when foreign loan comes at a lower borrowing cost, they will cost less or lower net borrowing cost, and they will give more spread. And we see that in that case, the impact of capital structure on profit will be a bigger number. Okay, other things remaining same. If the spread is a bigger number, in that case, you will see that the impact of capital structure on profit will be a bigger number. So what we have understood, can I recall that in the DuPont analysis, what we did, we measured the ROE by taking the net profit margin, then multiplied the three factor, the turnover, asset turnover, then we multiply this by equity multiplier, right? So is it a multiplicative approach, right? It is a kind of multiplicative approach, okay? But here in this class, or the level 1 breakdown of profitability, here what we are doing, we are taking the return on net operating asset and we are adding the impact of leverage, right? Impact of leverage. Is it a multiplicative decomposition? The level 1 breakdown of profitability analysis here. This one, is it a multiplicative approach? This one, this kind of decomposition? I see, no. So what kind of approach it is actually? This is a kind of additive approach, thanks. So you see how the viewpoint and this kind of decomposition is different. Someone has asked, would you please repeat what is the interpretation of the value 8.875%? Fine. So the 8.875% reflects the difference between the return you can generate by investing in your operations, or by concentrating on your operations, or by purchasing your net operating asset, or by spending money for net operating asset, and the cost you have to incur for the short-term borrowing. Sorry, you have to incur for the borrowing. Okay, or for the financial obligations. Okay, so if this number is a bigger number, bigger positive number, I mentioned earlier, you will be motivated to borrow more, to take loan, and to make investment in your operations. So you learn that the leverage gives us value. The financial leverage gives us value in terms of tax advantages or tax benefits. So the spread helps us to measure the tax benefit or the value additive by the leverage. If we multiply this spread 8.875% by our financial leverage percentage, in that case, we'll be able to get the impact of the financial leverage or impact of the capital structure. The can spread be 0? It can be. If these two are equal. Okay. So let me finish here. Next, we like to work on decomposition of profitability in level 2. You can recall that we concentrated more on the impact of capital structure in level 1 breakdown here. You see in the second part of this equation, we talked about the financial leverage and we concentrated more on this. But in level 2 breakdown, we concentrate on further breakdown of this return on net operating asset. So here you see the equations we'll be using for level 2 breakdown, for decomposing the profitability. So here we like to know the role of working capital management. Here you see that we have brought down the return on net operating asset. Return on net operating asset, because we want to decompose it, this portion. We want to decompose the return on net operating asset. It should be more precise, return on net operating asset. Okay, so you can recall the definition of operating income, which has been used here for measuring the return on net operating asset, this definition of operating income, right? So we took the reported income, reported operating income, and made some adjustment for what? Made some adjustment for operating items which are not accounted for operating income. You can recall the item, let me remind you, in the income statement there are some items. You see the other revenue and profit, we made adjustment for this, and employee benefit expenses, you also made adjustment of operating profit for these two activities, right? Okay, so note that it is after tax operating income. And you can also recall the tax allocation we made before making this for this adjustment. And you know clearly how can we determine the net operating asset. So because we need the net operating asset as the denominator for measuring the return on net operating asset. So in second level breakdown of the profitability decomposition, we mainly work with this equation, which I have selected here. And we basically look the breakdown of the return of net operating asset into return on operating asset and operating liability leverage multiplied by operating liability leverage spread. So here we want to see the role of operating liability on return on net operating assets. So let's see the calculation first. So we already have after tax adjusted operating income OI from here. From the previous calculation, you see the after tax operating income we already have calculated, and we have taken the return on net operating asset here, the same number 13.71 and 16.50 directly here. Okay. Since the company has significant operating liabilities, you see this company has a significant operating liabilities. We calculated in the calculation sheet the operating liabilities. You see 199 million in 2009 and 202 million in 2010. So we understand that this operating liability does not come at free of cost, right? So recall that credit purchase, which is a part of the operating liabilities in the form of accounts payable, it involves implicit interest payment, and we need to make higher payment compared to cash purchase when we make the credit purchase. Similar thing is true for other payables like wages payable or utilities payable. So however, in financial obligations, we make explicit contract. We make explicit contract to make interest payment. So for the operating liabilities, we made some reasonable assumption that consumer price index reflects the implicit interest payment or the cost of operating liabilities. And here you see that after tax interest payment is matter again, and we have calculated after tax interest payment, which is around 5.5 or 5.6 or 5.7% in our case. So we estimate implicit interest payment by multiplying this after tax interest rate with the operating liabilities. Let me show you the calculation again. What we have done, we have taken the operating liabilities and multiplied it by our proxy for the cost for operating liabilities or after tax short-term borrowing rate. Okay. Now we need to determine the return on total operating asset. Okay, we need to determine the return on total operating asset. But think of a context. We have no confusion with the operating income after tax adjusted operating income. But before talking about the whole definition of this ratio, return on operating asset, let me give you a context. So assume that we didn't have any operating liability. So what does it mean? The operating liabilities what we have calculated, note that these numbers are zero. We do not have any operating liabilities. So in that case, we could avoid the implicit interest payment what we have calculated here, and our operating income would be higher. Which operating income? If we do not have this implicit interest cost, okay, our operating income would be higher. Note that implicit interest payment increases our cost indirectly. How? It raises cost for inventory purchase. It raises cost for wages payment. It also raises cost for utilities payment. When we make deferral of the payment by making it as a part of the current liabilities. So in true sense, operating income will be here. The operating income will be the summation of after-tax adjusted operating income. This portion, you already have this after-tax adjusted operating income, and implicit interest on short-term liabilities, which we could avoid if we didn't have any operating liabilities. So for that context, we are adding back the implicit interest cost. Okay. So you see that what we have done here, we have insulated the portion of any impact of financing by ignoring any financial income or expenses. Okay. So we like to see purely the role of operation, purely the role of operation. Recall in the first level breakdown, we include the impact of financial leverage. See, in the first level breakdown, we include the impact of financial leverage very explicitly. And when we talk about the financial leverage, it is very easy to recognize since it is clearly reported in the financial statement. How? In the financial statement, let me show you in the income statement. The finance expenses, it is exclusively attributable to the financial obligations. So it is more explicit. But understand the impact of operating liabilities, what we have calculated, the impact of operating liabilities on the income statement, right? So do you see any item in the income statement which directly indicates the cost for operating liabilities? The answer is no. So we do not see any item in the income statement which directly indicates the cost of operating liabilities. So what I'm trying to say, if we do not have any operating liabilities, if this value is 0, we would not have any indirect cost of this kind of cost, implicit interest cost, right? So what we are doing, we have taken this, the implicit interest cost, which we would not pay if we had no operating liabilities, and we are adding the after-tax adjusted operating income and the implicit interest cost, and we are dividing this, the total of the after-tax adjusted operating income and the implicit interest cost by the total operating asset. Let me show you how we have calculated it. So from the calculation sheet, I have taken the, it starts with the first bracket. We have after-tax adjusted operating income, OI, plus implicit interest cost on operating liabilities, which we could avoid if we didn't have the operating liabilities. Now we divide this number by the total operating asset here. Note that it is not net operating asset, it is total operating asset. We are dividing this by total operating asset, the summation. Okay. So what is this? This is the return on operating assets. So we have calculated it. Now the question, what does it measure or what does it indicate, the 11.37? So note that out of the 13.72 taka, what we have generated from our investment in operation, return on net operating asset 13.72 taka, we generate 11.37 taka from our operation on investment from our operations. How we have made investment in operating asset, and from making investment in operating asset, we have made 11.37 taka out of 13.72 taka. Note that we have not included any working capital management or current liabilities issues because we have neutralized the impact of operating liabilities. So note the this issue that we have ignored, or we have insulated this ratio when we are taking the operating income and we have adjusted it, we have added the implicit interest cost we are incurring for the operating liabilities. When we are adding back, what is happening? We are assuming that we do not have any operating liabilities. We have the operating liabilities zero. So what happened? So we are insulating this from any impact of operating liabilities or current liabilities. So you see there is a difference between the 13.72 percentage and 11.372 37 percentage. So this is around 2.34 percentage. This is around 2.34 percentage. So what does it indicate? It indicates that this impact or this value is coming from the working capital management. Now, how can we compute this? This 2.34, what I just have shown to you in this way, 13.72 minus this 11.37, which is coming from the investment in operating asset, and this 2.34 is we just have took the difference, or we just have taken the difference. But how can we compute it using the formula? Remember how we estimated the financial leverage, because we'll use the similar concept now. How we estimated the financial leverage. Here in the calculation part, you see we have estimated the financial leverage by taking the net financial obligations over the common shareholders equity, or CSE. Okay, we took the net financial obligations and we divide this number by common shareholders equity. But now our task is to determine a new term, which is we call the operating liability leverage. We call the term operating liability leverage. So how can we calculate this? We can calculate this by taking the operating liabilities from where, let me show you, by taking the operating liabilities from here, this one. Okay, so let me start from here, equals to, by taking the operating liabilities and divide this number by the net operating asset. Okay, so here you see what we have taken as a numerator. We have taken the operating liabilities as a numerator, and we have taken the net operating asset as a denominator. Okay, now in financial leverage, what we do, we take the net financial obligations as a numerator and we divide this number by CSE, or common shareholders equity. So you see that it has been taken, or it has been termed as operating liability leverage. You can write it as OLL, because Penman in his text has termed this term as a OLL. Now we like to estimate the spread by subtracting the short-term borrowing rate, what we have approximated here, 5.79, here 5.62 in 2010. So we like to measure the spread by subtracting. Let me show you. We like to measure the spread by subtracting the return on operating asset. We take the return on operating asset and we subtract the after-tax borrowing cost. Okay, so here it is. So note that Bangladesh Lamps, or BD Lamps, what this company is doing. This company is manufacturing lamps and it has invested in operating asset, which is giving the return on operating asset, which is this portion 11.37. But while conducting operations, I mean the BD-LAMP, when BD-LAMP is engaged in operations, it also incurs some operating liabilities. So these operating liabilities have some operating liabilities have some explicit interest cost. What kind of operating liabilities can have explicit interest cost? Let me take you to the balance sheet. Here, say for example, in the part of the current liabilities, there's a short-term loan. So for that short-term loan, you have some explicit percentage if it is taken from the bank. But if it is the this is the financial obligations, but there are some operating liabilities in which you might have a precise number for interest cost or the cost which is not implicit, but most of the operating liabilities, the cost is more implicit. Okay, so for individual operating liabilities, say tax payable, say trade and other payables, we do not have any explicit cost. We assume that this have some implicit cost. Okay, so you know the argument we discussed in the level 1 breakdown, the issue of implicit cost. So as long as we do not have any costing for individual operating liabilities, what we do, we make a proxy by taking the average inflation rate, which is around how much? More than 5.5%, and that is our short-term borrowing cost. So what we are doing, we are subtracting these percentages or short-term borrowing cost from our return percentages, which is coming from return from investment in operating asset. So the difference is this difference. What we have measured here is the spread. So you see that as long as this spread is positive, in that case, if we use more operating leverage, the greater this number, more operating leverage or more operating liabilities, it will create value. It will raise value, and you know it, or you can compare it how the financial leverage creates value. And here we see how the operating leverage or operating liabilities creates value as long as the spread is positive. And in that case, if we use the operating liabilities or the leverage, we can create value for how much? We can create value for something percentages, which is 2.34%. I'll show you more precisely, but you see what we have calculated here. We have calculated here the spread. Now, what we have to do, let me raise it. We have to take the operating liability leverage, what we have calculated here, operating liability leverage, and multiply this number by the spread, what we just have calculated, 5.57%. So you see, same 2.34%, which reflects what? It reflects that this 2.234% value addition, it is coming from the working capital management. And again, the 11.37% is coming from the investment in operating asset, and 2.34% value is coming from my capability of managing the working capital more efficiently. So the question, is it really possible that we can create value by managing working capital? So there is empirical evidence that it is possible, that we can create value by managing working capital. So one of the classic examples of companies which manage inventory most efficiently is Dell Incorporation. So what this company does, this company orders for inventory to the suppliers upon getting the order from customers, right? So hence its cash is not locked in the inventory, and with minimum investment in inventory, they reduce the investment in working capital. And now if you compare this with another company like Telephone Shilpo Shasta, it is our local company which produces dual laptop, right? So what they have done, they have a huge pile up of the dual laptops in its warehouse due to shortage of demand and unplanned inventory management. So what we just have measured, the inventory management issue. This is part of how you're managing your working capital. Note that inventory management is a critical component of working capital management. And between the Dell Incorporation and the Telephone Shilpo Shasta, what do you expect? One company is incurring no investment in inventory, or their cash is not piled up. Sorry, their cash is not locked in the investment in inventory. In another company, the Telephone Shilpo Shasta has incurred, or their significant amount of cash is locked with the inventories. So between these two companies, obviously the Dell is managing its working capital more efficiently. So Dell should generate more profit or more value by managing its working capital. So if you compare, or if you have the information for both Dell and the Telephone Shilpo Shasta, you'll see these percentages, the impact of working capital management will be a greater number for the which company? The Dell company. Okay. So in summary, what we see, the financial leverage creates value, which is evident from the profitability decomposition in level 1. But in working capital management also creates value, and which is evident from the profitability decomposition in level 2 breakdown. Okay. Now let's turn to level 3 breakdown. Finally, we see in the level 3 breakdown what we are doing. Let me show you that what we'll be doing. We are interested to look into more detail on the components or the drivers of the return on operating asset. You see here the return on operating asset. It starts with the return on operating asset here. Now in the level 3 breakdown of the profitability, we like to look at this return on operating asset more closely. Okay. So what we'll be doing, this is more straightforward. We'll decompose the return on operating asset into two components. One is profit margin, and the one is asset turnover. So recall that in level 1 breakdown of the profitability, what we have done, we decompose the return on capital employed, or return on equity into return on net operating asset and the financial leverage, right? And in the level 2 breakdown, we made decomposition of return on net operating asset. How? We made decomposition of return on net operating asset by taking the return on operating asset and the operating liability leverage. Now we like to decompose this return on operating asset in the level 3 breakdown by looking at the profit margin and the asset turnover, right? So we like to see the decomposition of return on operating asset. Here you see the formula. So what we are doing here, we are multiplying the profit margin by the asset turnover. Note that if you compare this formula with the level 1 breakdown here, this is additive, right? This is additive. And in the level 2 breakdown, this is also additive. But in level 3, we see these have a multiplicative relationship. So in this way, a level 3 breakdown is somewhat different from the level 1 and level 2 breakdown. So let's try to calculate it. So we already know how to calculate the return on operating asset because we have calculated in the level 2 breakdown, right? So we have taken this number 1137 and 1290 directly here, 1137 and 1290 here. If I take this number to one more decimal, you see that this number is here. Okay. So again, let me remind you what we are doing. So let me make it more precise. We are taking the after-tax adjusted operating income, and in the similar context, we are adding back the implicit interest cost. It will be more precise if I write the implicit interest cost, and we have taken the summation of these two, after-tax adjusted operating income and the implicit interest cost, and we will divide this number by total operating asset. So we already have made this calculation in the level 2 breakdown. We are not showing this calculation here. So we need to calculate the profit margin and asset turnover. So we will be believing that these ratios are more familiar with us from the viewpoint decomposition of profitability, and but you will see some differences. Let me explain it. Say the asset turnover. Okay, the asset turnover. Let me calculate it here. So we are taking the sales from the income statement. The numerator, the sales is coming from the income statement. Here, the revenue, and we have to divide this number by the total operating asset. Okay, we already have calculated the operating asset here, the total operating asset. So what is it? It is the asset turnover. Okay. Note that we have taken the operating asset as the denominator. It is not the total asset. Additionally, note the differences in definition of the ratios we are using here and we use conventionally. Conventionally, we use the total asset for measuring the asset turnover in the denominator, right? And in financial leverage, what we do conventionally? Conventionally, we measure the financial leverage. Here, you see the financial leverage. We measure the financial leverage by taking the total liabilities or the total long-term liabilities as a numerator, and we divide the number as by the equity. It is the conventional measure. But here, what we are doing, we are taking the net financial obligations, and we are dividing this number by CSC or common shareholders equity. Okay, so let's return to the decomposition part here again. So we have this number, the asset turnover, and next one we like to calculate the after-tax profit margin. So again, there is little bit difference between how we calculate conventionally and how we be calculating here. So here our profit margin is somewhat different. What we are doing within bracket, we are taking the after-tax adjusted operating income, which is in our calculation part here, after-tax adjusted operating income, and we are adding the implicit interest cost on operating liability, which we would not incur if we didn't have any operating liabilities. Now, what we have to do? We have to divide this number by the sales because we are calculating the profit margin. Okay, so we're dividing this number by sales number. So here you see this is the profit margin. So how it is different from the conventional measure? In the conventional measure, we might take the net profit as a numerator, and in the denominator we take the sales. But here we have changed the numerator number. Okay, so that is all about that. How can we make the profitability decomposition in 3 levels: level 1, level 2, level 3, and this interpretation of the profit margin and the asset turnover, how they are contributing and how they are comparable to other companies, is more familiar or more clear to you as we have worked with the similar ratios, obviously with different definitions in DuPont formula. So profit margin indicates the profitability, and asset turnover indicates the efficiency measure. Okay, so altogether, a spread analysis is telling us how the company or how a firm incurs or generates value, and how they produces value or profit. Okay, so it comes from financial leverage. If we look at the profitability decomposition 1, we see the value is coming from financial leverage, which we have identified here, and we also have identified value comes from the working capital management. Here you see I have highlighted here, and in the level 3 breakdown we have been able to identify that value can also come from the profitability and the asset turnover or the efficiency. And finance has a big role, particularly in the capital structure, this one, and finance has another big role in the working capital management. And profit margin, asset turnover, these values are contributed with the contribution of multiple departments. It might include the logistics, it might include the contribution of supply chain, it might include the contribution from the production department, and other how the dominance of the company is in charging the prices from the customer. Okay, so that is all about how can we make the spread analysis, and or more precisely, how can we make the profitability decomposition. And now you might wonder why it is essential and why we are not satisfied with the DuPont. The answer is again, DuPont is also one of the very good alternatives that how can we decompose the profitability. But apart from the DuPont decomposition of profitability, this is more comprehensive, more interesting, and it provides more information for looking at the drivers of the profitability in 3 levels. Okay.